Welcome, Michael. How are you?
I'm doing great. How are you? Thank you for having me, by the way.
Great to meet you. I didn't know until I did due diligence at the last minute that you're part of the crew with Lance, because I've been to your website before and you're a partner at realinvestmentadvice.com, and you're also a co-founder of, what is it, 720?
720 Global.
Okay, so is that an RIA?
No. 720 Global provides economic macro investment advice to everything from individuals up to institutions.
Okay.
I joined with Lance at Real Investment Advice. I think we officially signed papers. It was October-ish, November. And we are working diligently to put together a subscription service, which is something I was doing at 720, but this will take it to even a greater level.
Okay, so we know where you are. Tell us how it began for you. The beginnings of your journey and how you ended up in this industry.
The beginnings of my journey are actually when I was 13, 14 years old. I was gifted some shares of Beefsteak Charlie's. Beefsteak Charlie's, for anyone that doesn't know, because they've been out of business for 20, 30 years, was a chain restaurant. Nothing special, but they used to have peanuts, and there would be peanut shells all over the floor.
You got those shirts for your bar mitzvah.
Exactly.
Okay, buddy.
and ever since then, I have loved the markets. So I wanted to. I went to college, got a degree in finance, and
that didn't help you.
That didn't help me, and then I had to relearn everything. I got a CFA about 10 years later. Again, I had to relearn everything. It was funny, when I took the CFA, there was a section on swaps and derivatives, and I had been doing a lot of that in the real world, and I really did have to relearn it to take the test.
Isn't that something?
Just
the difference between educational knowledge and practical knowledge are almost two worlds apart.
And different languages as well.
Right, and you know what, you can't learn experience. It only happens with the passing of time. So
that's right.
Very, very interesting market environment we're in now, Michael, since February, where the market became more binary. And before that, we were just in this parabolic or grinding higher, never really stopped for any kind of correction. And I've been to your website, and you guys actually do give advice about, protecting yourself. I've read Lance putting on and taking off hedges, recommending people do that. How do you hedge this market, and what are you telling people in this environment to do?
So it's a tough market. Fundamentally, there's no, in my mind, this thing is grossly overvalued, and this thing will correct. Fundamentally, we always revert back to the mean, regress back to the mean, if not lower.
Where's the mean? Where's the mean in your opinion? On the
in my opinion,
yeah.
I mean, it can be half of where we're at today, if not lower.
Okay.
We're at, on some measures, on almost.
People don't remember that markets could trade not just at book, but below book. Just like they could sell way above book, the market could sell beneath book.
Oh, absolutely. I mean, we saw it in 2008 and 2000, the S&P was down over 50%. So, that may sound like a startling number, but we've been there twice in the last less than 20 years. And you look at valuations on all kinds of, measured all different ways, and we're at or near the peaks. One of the graphs, I don't know if I can show this, but I will try. Can
got it. Nominal GDP.
Okay, so what I wanted to show, right, the one complaint that I get, or the one argument I get is, yeah, but valuations can go higher. They were higher in 1999.
Yeah, I've heard that.
And that's a fair case. That's a fair case. When you look at CAPE, for instance, I believe we hit 45 in the late 90s. and currently they're in the low mid 30s. And that's a fair argument, but what's not fair is you need to compare the environment of the two. In the late 90s, government debt was turning into they were starting to run surpluses for a year or two. Productivity was steaming along. The economy was growing twice the rate it's growing now. Baby boomers were spending like crazy. They were in the heart, they had kids and they were really in the heart of their spending cycle. So what I did was simply adjust CAPE for GDP. And when you factor in the environment, you can see that the current CAPE is actually much higher than where it was in 99.
Well, you could just eyeball a chart and look at the advance into 99 and compare it to the advance that we've had since the low in 08. And just the magnitude, the price move, the chart dwarfs. If you thought 2000 was a bubble after that advance, and you thought 2008 was a bubble after that advance, you can't help but look at the chart and say, this is not a bubble. You can't say it.
Right.
Don't you think with just price magnitude and duration?
That's right. But what really bothers me is, and I'd like actually comparing this to 1987, because 1987 was a bubble of sorts. Valuations got a little high. Interest rates were moving much higher. But in 1987, the economy was starting to boom. Again, demographics were in our favor. Interest rates were trending lower, even though they popped higher that year. And the environment in general was going to be very friendly for stocks. The economy was friendly. Now the market cracked hard, but it came back because at the end of the day, the support for earnings, which is the economy, was there. What bothers me this time, and it's unlike what we saw in 99 either, is that the economic support just isn't there. We have deficits that are both federal, corporate, and consumer deficits that are running sky high. And we are solely dependent on debt at this point for growth. Productivity has ground to a halt, and our demographics slowly start becoming a headwind instead of a tailwind. So what bothers me is that we're not only sitting at the perched at valuations that are either at peaks or unprecedented, depending on how you want to look at them, but at the end of the day, there's really nothing underneath it economically, fundamentally, to support it. Okay. And we've been slowly becoming more and more dependent on the Fed. So the logical question I think investors need to ask themselves is, can the Fed bail us out? And that's the experience so far.
I just want to give people a visual of what we're talking about here, Michael. So I'm going to make myself the presenter for just a second. Just to illustrate the point that we're talking about. Here's your advance into 2000. Okay. Right. And then your low in 2002. Here's your advance into the last financial crisis. And look at the advance we've had here. So the magnitude of the advance has been at least 2-3 times as much as the previous two so-called quote-unquote bubbles. So I just wanted to,
But the important part is, and I don't know, can you see that graph?
I'm going to make you the presenter again. I just wanted to show.
Okay.
Okay, the ball is yours. In honor of the NCAA championships, I just passed. I gave you a lob above the rim, and you jam it in, buddy.
Okay, I'm trying to jam it in.
All right, so you might have to.
I got it. I got it.
God, here we are.
So take a look at the graph on the right.
Okay.
And even the graph on the left. The left is just GDP growth year over year, and it goes up and down, up and down. Right. But when you take a look at 3-year moving averages, look at the trend. Yeah, so that's your support for earnings, and sideways to down. Yeah. And the Fed's telling you this. Their long-term growth forecast, I believe, is 1.9. It's just how much more debt are we going to add to the system, and can we? And again, I think this is a question of the Fed. How much more are they willing to print money and to boost asset prices?
Well, right now, you wouldn't say they're doing that, right? I mean, right now we have, instead of quantitative easing, we have quantitative tightening, right? Guys like Peter Bookbar talk about that.
Oh, absolutely. And this graph I just posted up there is the S&P from 2007, and then you can see the Fed balance sheet. And look how aligned the three green bars, the three green sets of bars on the S&P line. Yeah. Look how aligned they are with QE.
Yeah.
Now the only thing that really stands out is that purple area. This graph is slightly old, so it's should have been up at 2,800.
Right.
But it's the enthusiasm over Donald Trump being president, which over the last month or two may be losing a little steam. But in the meantime, that's what's driven the market. It's QE. And prior to the what we call the Trump bump, the market was actually lower during periods when there was no active QE going on. So the Fed has printed almost $4 trillion. They've bought Treasury securities. So it's not a direct link to the equity market, but they've taken $4 trillion of fixed income securities out of the market. That money has to go somewhere.
Yeah, so it was forcing people, what they call that, suppression or economic suppression, so that savers got hurt and were forced to take risk to earn a yield and a return.
That too. But I mean, just think, if you owned a 10-year Treasury, the Fed bought it from you, you have to go buy something else. So eventually it works its way up the pipeline. You may buy a AA corporate bond, so you're not taking that much more risk. But then the guy that owned the AA corporate bond is going to go into junk, or he's going to go into single A, or he's going to go into equities. And it works its way up the chain. So now we're looking at the opposite now. The Fed is slowly, and I mean slowly, if you look at the increases here, the decreases are coming off much slowly, but they are taking liquidity out of the market, which is having the opposite effect.
Right. You know what?
And
go ahead. Finish up, Mike.
I was just going to say, at the same time, they're raising the Fed funds rate.
Right. And the short end for financing our national debt isn't making it easier, because the yield curve, the big move has been on the short end. We've seen it, triple, the rate triple in the last 6 months, LIBOR, et cetera. So, I read something on your realinvestmentadvice.com. I was starting to read, you were doing a piece, you wrote a piece on treasuries. And since we're talking about historical things, I was rather surprised to see that when we had 1,000-point down days, 700-point down days, that the old flight to quality trade into the bonds was almost non-existent, that there may be a new paradigm going on, that they could both be bad together and both be good together, but there was no flight to quality or marginal flight to quality into the bond market on those big sell-offs. It looks like now the flight to quality is to cash.
Well, that's the million-dollar question. So I just pulled up two charts. The one that you can see right now shows how over the last 4 recessions, the difference between an S&P portfolio and a more traditional 60-40 S&P 10-year Treasury portfolio, simple portfolios. But you can see by the green bar how having almost half of your portfolio in 10-year Treasuries has hedged during those big drawdowns. So that's the million-dollar question. And that gets you to the article I believe you're talking about.
Yeah.
Which is, and it's not just 10s, 2s, 5s, 10s all look the same. And they all have a very similar channel pattern.
On the verge of breakouts everywhere?
Well, that's the million-dollar question, right? So what we did in that article was we looked at the period here, 87 and 89, what happened. We looked at 94, we looked at 99, and we looked at 2007-8. Now, we all know that 87, and then we had a recession in the early 90s. The market was down, I believe, about 20%. I'm going to skip 94 for a second. 99 in 2008, S&P was down almost 50%. Techs were down about 83%, I believe it was in 99. 94 was the anomaly. We had a lot of problems that occurred in the debt markets, Orange County, Mexican peso crisis, but the stock market pretty much held its own. So the question is, now we're looking here, we're at that line again. It's interesting. The most common analysis I see is, well, rates have only gone up a point and a half. If you look at this line compared to that, it's not that much, or that, or that.
Yeah.
Here's the problem with that analysis. So say we've gone up a point and a half today. We went up 3-4 points those times.
From
the amount of
levels.
leverage today.
Yeah.
Well, from higher levels, but the amount of leverage today is much greater than at those points. So it's not just the change in rates. It's the change in rates times the amount of leverage. When you have $1 million house on a floating rate mortgage, that change is much greater than when you have a $400,000 house on a floating rate mortgage. So I think we're at a period that really matters. Do we go lower? Do we go higher? In that article, I also said we could meander. I just don't think that's what's going to happen. I personally think we go lower. I think that, yes, bonds are in a bubble, and yes, rates will be higher in the future. But I think in the short term, we may go back and test those lows of 2016 before the ultimate trip.
What, 130?
Much higher.
130 in the 10-year, I believe.
Right.
Okay.
That's correct.
All right. So let me ask you this. Do you do any sector work with the market? Do you think that there could be, perhaps a lot of people are looking for the potential with trade wars or incipient inflation? Commodity markets have been very depressed. Are you interested in the oil sector? Are you interested in the precious metals sector in any way?
I do like the precious metals, especially gold. Although silver technically is looking like it's ready to break out in a big way, but I think gold, and I'm not necessarily a gold bug. I just think there are periods in time when it's important to own gold as part of a well-balanced portfolio. The government, not only here, when I talked about the Fed printing $4 trillion, that's on top of 12, 13, 14 trillion from all the other major central banks. Right. So the dollar, the yen, the euro, the pound, everything is being debased in a big way. And the question is, what can you own? I'm not a buyer of Bitcoin yet. I fear that the government will.
Would you buy it at 2,000?
The problem I have with Bitcoin, I love the concept. Maybe not necessarily Bitcoin, but I love the concept of Bitcoin. The problem I have with it is that the government will not like the competition. So when I pay you over Bitcoin, it's hard to tax. It's very easy to do illegal monetary transfers. At the end of the day, the nation must have control over its currency. And it's not clear to me that they have control over their currency with Bitcoin. So it doesn't mean Bitcoin. I'm not saying Bitcoin will go away, but what scares me from it is what the government does and how it controls Bitcoin. And then when they do that, is it still the same investment?
Well, maybe they're letting this grand experiment go forward so that the public becomes comfortable with it before the Feds put out their own cryptocurrency.
Absolutely.
I did want to ask you something when it came to the gold. What kind of ownership do you recommend, like an ETF like GLD? Because I've noticed some miners have been way underperforming bullion, and normally that's not such a good sign for the bullion. It's better when the stocks lead the underlying commodity.
Right.
How do you tell people to own it? ETFs, miners, physical?
I kind of think there's kind of three ways to own it. You can physically own it, you can trust someone to own it for you, or you can own it through the miners. With the miners, you're basically buying gold that's in the ground. The problem with the miners is that they have proven to be very poor managers of businesses in the past. But like you said, some of these guys are trading below book value. They're leveraged to the price of gold. So if gold pops, the miners should do very well, especially given that their prices are, compared to the price of gold, very low here.
Any view on
gold itself?
Any view on the energy markets, that space?
It's getting pricey here, but there's there's a lot of geopolitical things going on in the world. So,
Sure.
Saudi Arabia, Iran. So I think it's a little pricey, and I think at the end of the day, that's, this goes back to some fundamentals, that this is a big problem for the economy as we're getting into the mid-upper 60s. If we get into the 70s and 80s, you're going to see an effect, which will slow down the economy. And I don't think the economy is growing all that fast. I think we're going to see GDP growth sub 2% in the first quarter. And if you start ramping up oil into the 70s, I'm not so sure we don't stay in the ones or actually drop lower.
Okay. Well, I appreciate your views. Any one last thing you'd like to wrap it up with as you look ahead into, we just entered the spring season, spring into summer. What should we be keeping on our radar, according to Michael Lebowitz?
Well, I just think it's important to have a balanced opinion. So I presented a pretty disturbing fundamental view, but I really think that you need to follow the technicals, you need to follow the market sentiment. And right now, the bull market is still in control. You have to give the stock market bull the benefit of the doubt until it technically starts proving otherwise. It's
do you have a red line? Do you have any kind of red line that would tell you that the bulls have lost control price wise? Or
we have to break the buy the dip mentality, and so what that's going to be is a series of lower lows and lower highs.
Great
and
point.
That's what I'm looking for. How the pattern actually shows up, I'm not sure, but if we keep reaching lower highs and then falling back down, that's breaking that muscle memory of the market and the algorithms that drive it.
Okay, what a great way to wrap it up, Michael. Thank you so much for your time today. People could follow you at Michael Lebowitz, and there's Michael's website, and this is for subscriptions and market letters and great content.
Thank you. We post articles all the time, so feel free to hop on the website, realinvestmentadvice.com, and check us out.
Thank you again, Michael. You're now my trading warrior brother. Thanks for your views, and I really appreciate you taking time out of your day. Say hi to your team. Yeah, say hi to your team for me, and good hunting during the spring quarter. I hope it is a prosperous one for you and all your subscribers.
Great. Thank you very much, Dale.
Okay, Michael. All right,
F.A.C.E,
you're very welcome. People enjoyed your analysis, and that's a wrap for Turnaround Tuesday. See everyone tomorrow. Good hunting the rest of the day. And remember, don't just count your pips, count your blessings. I'll see all you warriors tomorrow, bright and early, 5 a.m. from Southern Cal. Live. The F.A.C.E Show. Adios. You're welcome.